Hi, I'm Jimmy. In this video, I'm going to walk through a quick analysis of the financial sector, which looks like it could be undervalued, in the hopes of trying to find which pockets of the financial sector look to be most interesting. Once we identify which parts of the financial sector look the best, well, we'll take a moment and we'll dive into the companies within that industry, and then we'll go ahead and pick our favorite within the industry. So in a recent video we did titled, "Is the stock market too high?" Two sectors that looked to be a good value. Well, the financial sector was one of those sectors. The other sector was the material sector. And I plan on diving deeper into each of those two sectors to see if they really are a good value and which pockets of those sectors appear to be the best value. This video, we're going to dive deeper into the financial sector. So just so we're on the same page, I just want to break down how I'm coming up with the numbers that I'm using and how the sectors are broken down. So in the last video, I referenced GICS sectors, which is short for Global Industry Classification Standard. So GICS breaks down all publicly traded companies into these 11 GICS sectors. Now, since we're looking closer at the financial sector, I'll break that one out even further so we can see how the industries play into it. So if you're ever wondering the difference between an industry or a sector or a sub-industry, well, this is how GICS breaks it down. So we start with the sector, and in this case, it's the financial sector. And then the sector can be broken into industry groups. These are the three industry groups that fall within the financial sector. We have banks, diversified financials, and insurance. So these three fall under what GICS classified as level 2, which is industry groups. Now, industry groups can be broken into industries. Industries are considered level 3. And as we can see, there are logically a lot more industries than there are industry groups. And then we can break industries into sub-industries. Sub-industries are often called level 4, according to GICS. Now, we may also notice that not all industries are broken into sub-industries. Insurance, as an example, stops at the industry level. So the way I did this analysis is I looked at the companies in the S&P 500 by grouping. So for the consumer finance industry, just as an example, there were 4 companies within that industry. They were Discover, Capital One, American Express, and Synchrony. But that isn't all the companies in the industry. These are just the companies that are in this industry, and they're also in the S&P 500. If I stuck with all the companies in the United States that fell into that sector or that industry, well, there would be 92 companies. In Europe, I found over 800 companies, and worldwide, there were about 1,300 plus. So I just wanted to clarify that what we're doing is we're sticking with S&P 500 companies. We're not pointing out all the companies that are in that industry. Narrowing it down like this makes it easy to get through all of the data. And in my case, I'm actually using indexes that were built by Standard & Poor's for each of these groupings. So that speeds up the research process even more. Now, I recognize that YouTube is a global platform, and our community goes far beyond just the shores of the United States. So if you want me to do a similar analysis for other parts of the world, let me know in the comments below. I think it could be very interesting to expand beyond just the S&P 500. Okay, so since we know that we're only dealing with companies that are in the S&P 500, well, clearly not all of these groups are going to be represented by S&P 500 companies. So these are the groupings that have at least a few companies from the S&P 500 in them. So we're left with 8 different groupings for us to analyze. So let's see where the value is within these groups. First, let's clean all this up. Okay, so in our last video, we identified that the financial sector was a potential value because it had an average PE for the entire sector of about 13.2x, which was low relative to the market and other industries. Now, that 13.2x is a trailing PE, which means that it uses the last 12 months of earnings versus today's price. But personally, I much prefer a forward PE. Forward PE looks at the next 12 months of expected earnings according to analyst estimates. This is an advantage of using S&P 500 companies since they tend to have a lot of analyst coverage. So the forward PE for the financial sector is about 11.9x. And as I pointed out in the last video, and as others pointed out to me in the comments, we can't really say if that's a good value unless we compare it to something. Well, I checked the historical averages for the financial sector, and their 2-year average came in at 12.9x. And their 5-year average came in at 13.3x. I also checked the 10-year average, and that came in the same as the 2-year average, which was 12.9x. But for this video, I'm just going to stick with their 2-year average and 5-year averages, And then we're going to try to identify which sectors, using their own historical averages, look to be the most interesting. So it seems that the financial sector does look like a relative value compared to its own history. But now let's run through each of the industries to see where they stand relative to the sector and relative to their own history. So diversified banks comes in right now at about 10x, which looks good relative to their 2-year average of 11.5x and their 5-year average of 11.3x. Okay, not bad. Regional banks currently has a forward PE of about 10.7x, which is less than the sector and less than their own 2-year average of 12.8x and their 5-year average of 12.7x. Okay, so let's just speed this up a bit, and how about we just unveil all the data for now, and then we can break it down from there. Okay, so at first glance, we can eliminate financial exchanges and data as a potential value since it is both above the sector and above their own averages. Diversified financial services falls into the same category, so we can cross that off the list, and insurance looks like it's both fairly valued based compared to the sector and to its own history. So I'll cross that one out as well. Okay, now let's narrow this down to just the industries that appear to have the biggest gap between their own history and their current forward PE. So let's cross these industries out as well. This leaves us with just 3 industries. So now it's a matter of narrowing down these 3 industries into the one that we want to look closer at. So the regional banks industry has 14 companies in it that are also in the S&P 500. So that's probably a bit too much for us to dive through in this video. So I'm going to cross that one out, even though it's possible that there may be some great investment opportunities in there. But that's sort of the nature of the game. We've got to decide what we want to research and what we don't. Okay, this leaves us with 2 possible industries to consider investing in. So the first is the diversified banks industry, and then we have the investment banking industry. So now our question is, what is the best way to value these specific industries? And although price to earnings works for both of these industries, I could easily make the case that a better way to value these types of companies would be to use a price to book value, or more specifically, price to tangible book value. I think that that would be the best way to value these types of companies. So now if we switch to price to tangible book value, well, once again, we can compare it to their own 2- and 5-year averages. Well, it looks like diversified banks is trading below their 2-year average, but above their 5-year average. So it's a little bit of a value. Investment banking and brokerage, on the other hand, is trading right at its 5-year average, but further below the 2-year average. So I'd say we focus there. And this should be quick because there's only 5 companies within this industry. So these are the 5 companies that are within this sub-industry. So now we can add the current price to tangible book value and the 2-year and 5-year averages. Well, now we can start by crossing some of these names off the list. So first up, we have E-Trade. And we can see that E-Trade looks relatively overpriced compared to its own history. And we can see that because the price to tangible book value is higher, the current price is higher than both their 5-year and 2-year averages. So we'll cross them off the list. Now, I also want to point out that E-Trade is a fundamentally different business than something like Goldman Sachs. That's why I'm leaning on their own histories and not the industry numbers. That being said, Charles Schwab looks like it's doing pretty good compared to its own history. Looks like it could be a pretty good value. So does Goldman Sachs. But both Raymond James and Morgan Stanley look like they're at best fairly priced. So let's cross them off the list. So when we clean this up a bit, well, we can see that we're left with Charles Schwab and Goldman Sachs. And I actually did a video on Goldman Sachs, and I'm a huge fan of this company. And the fact that it's trading less, it's trading for less than price to tangible book value seems like a great opportunity to me. Now, I'll leave a link in the description below for if you're interested in a more thorough stock analysis for Goldman Sachs. I love the company. And then we have Charles Schwab. Now, I haven't looked closely at Charles Schwab's stock in a long time, so it'd be tough for me to say whether or not I really like this stock like I can say about Goldman Sachs. That being said, if you'd be interested in seeing a deeper analysis on Charles Schwab, a lot like we did for Goldman Sachs, link in the description below, let me know in the comments, and I'll be sure to dive deeper into that stock to see if we can give a better assessment as to whether or not it's a fair value. Because I often believe that it takes more than just these, frankly, very shallow numbers. This is a great way to identify good opportunities. Goldman Sachs is a good example of that. We did a ton of research on that. I really like the company, and now it looks like it's trading at a really good value. So for me, I'm happy with the takeaway that Goldman Sachs looks like a great deal right now. It's in the right sector. The sector looks cheap. It's in the right industry. The industry looks cheap. And it looks like the company looks cheap right now. So the only thing I'd want to double check is to make sure it's not a value trap. Make sure some news hasn't come out recently that is somehow forcing the stock lower, and perhaps it should be lower. I haven't seen anything like that, but if you have, let me know in the comments below. That being said, do you think that Goldman Sachs looks like a good buy right now? What about Charles Schwab? Do you own it? Have you seen anything about it? Do you think we should make a video on that? Let me know in the comment below. So I want to thank you for sticking with me all the way to the end of the video. If you haven't done so already, hit the subscribe button, hit the thumbs up. Thanks for sticking with me to the end. Any comments, questions, or anything, put in the comments below, and I'll see you in the next video. Thanks.